Hello everyone, how are you all? I'm Dr. Labib from Dr. Labib's Academy. Welcome you all to our sessions related to ACCA and today we are going to continue with what we have left in this is ACCA Financial Management. I kindly request you all to subscribe to my channel, share this channel, watch till the end, post your comments, and if you feel you really made some value added to your knowledge, like the channel. Okay. This is the series. In the previous sessions I have done till 68, section A. This is section A, continuation of this. Okay, financial management. I'm following the Kaplan text, and appropriately you are getting the resources as such. Is it? This is the series of fifth one. Okay, I will put this for your understanding so that it will be easy, that you will not get confused. Okay, I kindly request you all once again, please subscribe the channel and share this channel, and any comments you just made it fine. Coming back to this regarding the financial management, investment appraisal. Okay, before we start the things as such, just I want to make it clear that the investment appraisal, okay, investment appraisal methods are there. Okay, a few things I will clarify you before we start the questions as such. There are different methods are there, is right? When that different methods, they are broadly classification of two methods, is right? Two broad classification. The first one is traditional methods. The first one is traditional methods, and the second one is discounted cash flow. In the traditional methods, okay, in the traditional methods we have the payback, is it? Payback period, and we have accounting rate of return. I am giving you from the basics, okay, and these will not take into consideration the time value of money, whereas in discounted cash flow the very basic principle is we will take time value of money into consideration. Once we are taking the time value of money into consideration, it is nothing but we will take into consideration the discount rate. Fine. Now what are the different methods here? You will have a net present value. We will net present value. We have internal rate of return, and we have profitability index. PI, where we call it as PI, we call it as IRR, we call it as NPV. Okay, and apart from that you will have MIRR, and you have discounted payback period. Okay, discounted payback period. So now this is one aspect where we are covering the things. Okay, now coming back to the things as such, when we follow the rules, is it right? It's all about what? It's all about the discount rate, is it? The discount rate. First I will give you the thing. Now discount rate is the rate at which the cash flows will follow, will be applicable. Okay, will be discounted. Now if the discount rate is represented by R, if the value of R increases, the present value will decrease. If the value of R is decreasing, the present value will increase. This is a reciprocal. So we will have to make sure that yes, we have 5%, we have 10%, we have 15%. We should know. We should not take that 15%. Another thing that 15% is more attractive. The higher the rate of discount rate, is that I will write here for your understanding and communication. Is that for your basic understanding? The thing is that the higher the rate, is it right? The higher the rate, the more risky the project. The higher the rate, the more. So we should not think that at 15%, and we will prove it. We will put it by theory. We will prove it by applications. And if we are taking the discount rate, we will calculate present value. Present value is nothing but cash flow divided by 1 plus R to the power of T. Okay. These are the things we will cover. Apart from that, what we are going to cover, see, every method will have the rules with respect to when we should accept and when we should reject. Is that all the rules, whether you take the things with respect to traditional methods or you take the things with respect to discounted cash flow methods. Okay, so every method will have. This is a brief basic. See why we do this. See, when we do the things, these are all estimates. These are all forecasts. As simple as that. Is that we will estimate before we make a commitment. We will evaluate the projects. Is that we will evaluate. We will estimate what is the cash outflow, what will be the cash inflow, what will be the discount rate, how much it is going to be worthy or not. And based on specific guidelines and specific rules, we will make sure that whether we should accept the project or we should not accept the project. This is called as a investment appraisal. Fine. Coming back to this. Now we will start. Once we will start the things, definitely the more we will have the things, I will explain you accordingly. A company, first 6-point number, you put one line here so that you should not. After every question I will put one line. A company is considering investment in a 2-year project. Mission setup cost will be 125, payable immediately. Payable immediately means it is in the year 0. Working capital is required at the beginning of the contract. Again, beginning of the contract means year 0, and it will be released at the end. When it is a 2-year contract, means it is released in the year 2, at the end of year 2. Given what is the requirement? Given the cost of capital. The cost of capital is otherwise is called as a discount rate. What is the minimum accept? Means what we have to do? First we have to convert it into present values. Then we have to come back into the nominal values. Okay, this is the process. What is the minimum acceptable contract price to nearest thousands to be received at the end of the understanding? First we have to convert it into present value. Then we have to convert it into nominal value. Then we will get the things. Now what is there? They will say, see, you put the things. You will put an year. Is it? You will put a year. You put the cash flow. You put a cash flow. They will say discount factor at 10% and present value at 10%. Okay, at 10%. See, this is going to be, this is column 1, this is column 2, this is column 3, this is column 4. Column 4 is nothing but 2 times 3. They say year 0. See, at at any discount rate, year zero, is the year zero, the discount factor will be always be 1 only. Any discount rate, year zero. Today value will remain same. Tomorrow the value will decrease. Okay, and it is time value of money. As the time progresses, the value of money will decrease. Now, what is the first one? Is year zero. How much is the investment? 125. If I am putting in brackets, it is minus. Okay, discount factor will be always be 1. Any discount rate, year zero, it will be 1. Column 4 is column 3, 2 minus column 3, 125. Any doubts, anything is there, just put it in the comment section. I am here to clarify. Okay. Next, again they require, how much they require working capital? They require working capital of 4,000. This is also 1. Year zero, the discount factor will remain 1. How much is there? 4,000. Year 2, at the end of year 2, they will get back, there will be released. Means they will be released means, see, what is working capital? Working capital is nothing but, it is not permanent capital, it is temporary capital which is flowing from in and outside to the during the projects. Okay, 4,000. How much is there? See, they will give you a discount factor. There are two things. Again, I just want to make it a point. Okay, there are two things that has to be taken into consideration. Where is the fine? Is it right? One is present value tables. Is it right? Present value tables. And the second one is annuity value tables. Present value tables are used. See, I'm just giving present value tables are used when there is a inconsistent cash flows. Annuity value table will use when there is a consistent cash flows. Okay, this is a brief one. They will give, you have to refer the present value table. 10% year 2. How much is there? It is 826. Is it? It is 4,000 into this one. It comes to how much? It comes to 3304. How much you will get? You will get how much? You will get 696,521. Okay, this is nothing but the, see, this is minus. Okay, this is minus, as simple as that. This is the present value. But what we have to do? We have to write contract price at year 2. Is it right? Contract price at year 2. How much is there? Present value. Okay. Present value of contract price. Now we got present value. Now we want what is the actual value. That's what we are saying. What is the minimum they will acceptable contract price? You have to, what we have to do? We have to convert it. The price is going to be how much? The present value of contract price divided by 1 plus 1 divided by 1 plus r 1 minute. We can put like this in the easiest form. Yeah. Discount factor at the rate of 10% year 2. Okay, 125 means we are getting back this into year 0. Is it right? 826. It comes to how much? It comes to 152, 170. They are asking us it should be rounded off to nearest thousand. Means what we have to write? 152,000. Is it 152,000? This is the way we have to work it. Next, which two of the following statements are true? Tax allowable depreciation. Tax allowable depreciation is a relevant cash flow when evaluating borrowing to buy compared to leasing as a finance choice. They are asking whether it is tax allowable depreciation is a relevant cash flow when you use borrowing to buy. It is tax savings, is it? On a tax allowable depreciation. It is not tax allowable. You will have a tax savings. You will have see, I will tell you this, is it? You will have whatever the depreciation, on the depreciation you will have a tax savings on tax allowable allowances. Is it right? And it is not that only the depreciation that matters, okay? Asset replacement decisions require relevant cash flows to be discounted by, it is not after tax. Is it right? What we are doing, we are talking in terms of what? When we say it is not a cost, it is a cost of capital. In the previous case we have done. Is it right? If the capital is rationed, rationing means we have a limited resources, we have more number of projects, attractive projects. Is it right? When we have the divisible investment proposals can be ranked by what? Profitability index. See, profitability index, one of the conditions or one of the criteria of profitable index, it is used whenever there is a capital rationing. Is it right? Whenever there is this is one of the criteria, one of the rules which you are going to use in capital rationing. Government restrictions of bank lending are associated with hard capital rationing. Is it? There are two things. Is that there is one called as hard capital rationing. Is it? There is one hard capital rationing. The another one is soft capital rationing. Hard capital rationing will be done from the external sources. Is it right? External means financial external to the company. External sources, external to the company, banks, governments, okay, financial institutions, leasing company, wherever we will get. Whereas soft capital rationing is from the internal. By whom? By the management. This is the basic difference between hard capital and soft. Government is an external source. Is it? Government is an external source. Is associated with hard capital ratio. Fine. This is now you should make it sure that how it will work. Now, a company has 31st December accounting year. On January 1st, a new machinery has been purchased. Is it right? A new machinery. A new 1 minute. Fine. A new machinery has been purchased. For how much? 2 million. The company expects to sell the machinery when they have purchased it. When they purchased it in 2005, they want to sell it in 2006. Means within 2 years. Is it? Within 2 years. The rate of corporation tax is how much? 30%. Tax allowable depreciation is obtained. See that they are mentioned at 25% the reducing balance, and the balance allowance is available on disposal of the asset. The company makes sufficient profits to obtain relief to tax allowable depreciation. What it says, what is the requirement? Means they have purchased the asset for 2 years, corporation tax is 30%, the reduced depreciation is 25% on reducing balance method. Okay, the company makes sufficient profit. If the company cost of capital is 15%, what is the present value of the tax savings? First, we have to calculate the tax savings. Then we have to calculate the present values. Okay. Now here I will put here only. Okay. You will have the year. Everywhere it is the same concept, is it right? You have the year, you have the particulars, is it right? Particulars, date, or all the things you have in terms of tax saved. Okay. Now year is 0. Where what is that? It is on 1st 2005. How much they have? They have invested. They have invested how much? They have invested 2 million. Okay, 2 million. Is it? Next, at the end of year one is nothing. At the end of year one, is it? At the end of year one, how much is the tax allowable depreciation? Is it? Tax allowable depreciation. How much is the tax allowable? It is 2 million. Is it? It is 2 million. 25 by 100. Okay. How much is there? It is 500,000. At what is the tax? How much? What is the tax? They are talking. Tax rate is how much? Tax rate is 30%. How much they have saved? They have saved how much? 150,000. How much is the balance left over? Balance left over is 1.5. Okay. Next. See what they are doing. This is year one, is it right? This is year one. Year two, they are selling the asset. The company expect to sell the machine for how much? 350,000. Is it right? 31st December 2006. Is that? It is the sale value. Is it right? It is the sale value. How much they are selling? They are selling it to 350,000. Okay, 350,000. How much is there? 1150. At the rate of how much? At the rate of 30%. Is it right? At the rate of 30%. 1150, 30%. How much we'll get? We will get 345,000. Okay. Now this is the amount. This is the year one. This is the year two. Now what is the? We have to take present values. Okay. Well, what is the? They're asking what is the present value of tax saving? Present value of tax savings. Is it right? Year one. Is that year one? How much is there? 150,000. Is that 150? At the rate of how much? At the rate of 15%. Is it right? At the rate of 15%. You can put like this also. Divided by 1.15. Okay. 150 divided by 1.15. It comes to how much? It comes to 130,435. Year 2. Yeah, 345 divided C by 1. C divided by 1 plus R. Okay. C divided by 1 plus R. 1.15 to the power of 2. Is that 345 1.15 divided 345 divided 1.15 1.15. Okay, it comes to how much? It comes to 260 869. Okay, how much is there total? You will get is it right? It comes to how much? 391 304. They say that to the nearest thousands. Okay, if you take 39130. Okay, fine. Now see, this is the way we have to work it out each and every case. Now what is it? An investment project has a cost of 12,000 payable at the start of first year of operation. The possible future cash flows from the investment a project has following present values and associated probabilities. They say year 1 probability, year 2 year 1 is how much? 16,000, the probability is 0.15. See, always the probability will be equal to 1. Okay, always this is the one. So now we have to know what they are asking us, what is the expected value of the NPV of the investment project. Is it expected value of the NPV of the things? Fine. Expected value of the investment has a cost of how much? Cost of 12,000. Okay, cost of 12,000. Present value of cash flows is how much? 4, 16, 12 and 4, 20 and 2. Payable at the start of first year of operation and investments at the present. Fine. Now, what we have to take? We have simplest one here. Year 1 is year 1. Is it year 1? What we have to do? We have to take the cash flow times probability. See, this is CF1. Okay, this CF1, this CF1, and this is okay. This is CF1. Okay, this is probability 1, and probability 1. Okay, fine. Now, in simple terms, we can say that it is summation of CF1 into probability 1. Okay, summation is the total. Fine. How much is there? Year 1, 16,000 times 0.15 plus 12,000 times 0.6 minus 4,000 times 0.25. Is it right? No. How much is there? 16,000 0.15, it comes to 2,000, 2,400, 12,000 times 0.6, it comes to 7,200 minus 1,000. Okay, 2,400 plus 7,200 minus 1,000. It comes to how much? It comes to 8,600. Fine. Year 2, again we don't do anything else, directly we can do. Is it right? Is it 20,000 times 0.75 minus 2,000 times 0.25. 20,000 is 15,000 minus 500. It comes to how much? 14,500. Total will be how much? Total will be 8,600 plus 14,500. Is it right? Right? Now, what they are saying? NPV. Is it right? This is present value year 1. This is present value year 2. Is it right? NPV is nothing but, is it right, minus cash outflow plus present value year 1 plus present value year 2. How much is minus 12,000? Okay, how much is there? Minus 12,000 plus 8,600 plus 14,500. It comes to how much? 11,000. Okay, answer is what? Answer is C. A company has a money cost of capital is how much? 21%. The inflation is currently estimated as 8%. What is the real cost? Is it right? When we take into consideration the real cost, okay, what is the rule, it says that the equation will be like this. Is it right? 1 plus money cost. Is it right? 1 plus money cost is equal to, was it right? 1 plus real rate. Is it right? 1 plus real rate times 1 plus inflation rate. Okay? 1 plus inflation rate. This has been given. Okay, now what we want to know? We want to know what is the real rate. Is it right? This is the money cost. Okay, money cost of capital. It is the inflation. Real rate is nothing but 1 plus money rate. Is it right? 1 plus money rate divided by, you convert this equation. That is said 1 plus inflation minus 1. Okay, it is 1.21 divided by 1.08 minus 1. If you put it like that, how much you will get? You will get 1.21 divided by 1.08 minus 1. It comes to how much? It comes to 0.12 or 12%. Right? Now, a company is considering a project which has initial cash outflow followed by several years of cash inflows. Which of the cash flow with a cash flow in the final year? How many internal rates could be there for this period? See, a company is considering a project which is having an initial outflow followed by several years of cash inflow with a cash outflow of in the first. See what happens. See, if the rule says, is it right? If the rule says that see what is the cash outflow? Cash outflow is nothing but CF0. Is it right? There are two things. Assume you have CF1. Okay, you have CF. Is that and ultimately you will have plus, and you will have so many things, plus, minus, you have CFEN. There are two cash outflows. Is that there are two cash outflows? When there are two cash outflows, is that there how many sign changes are there? Two sign changes. Is that if there are if two sign changes, is it right? Sign changes, it will have. See, it is given clearly in the study text. Okay, conceptual. You just refer it. It will have how many? It will have two IRRs. Yeah, it means you will have IRR with respect to 0, with respect to 1, with respect to 2. Is that means depending on the magnitude of the cash flow. As many IRRs as the sign changes. Is that how many times it is going to change the signs? That many IRRs it will have. The answer is where? The answer is C. Now, they have 1 minute. Is it a company has a fine. A company is considering initial two cash flow which is having the fine. Okay, 0, 1, 2. Initial cash flow is several years of fine. Okay, next. What they say that it is there. Fine. Now, how it will work? See the thing. What they are asking whether the payback period will increase or decrease, or whether the internal rate of return will increase or decrease. See, if the cash flows, increases, cash inflows. Okay, inflows increases. What will happen? As simple as that. What will happen? The payback period. Don't do all the calculations. Is that you have to be very conceptual, understand the concept. If the cash flow increases, what will happen? The payback period will decrease. Is it? Definitely you will recover the investment as quickly as possible. If the cash flow increases, what will happen? The payback period will decrease. Now coming back, this is related to what? This is related to cash flows. Internal rate of return in terms of percentage. I told you in the beginning. Is that I told you in the beginning? If the value of R increases, what will happen? The present value will decrease. If the present value will decrease, what will happen? The recovery. Is it right? The recovery will take more time. Is it? The recovery will take more time. See, when the rate of discount rate increases, it is not financially healthy. Is it? Internal rate of return will increase. When the internal rate of return increases, definitely what will happen? The present values will decrease. Okay, the things is you have to be that much specific. The lower risk of the project can be recognized by increasing which of the following. Okay, what is the lower risk? Is that the lower the risk of the project? The lower the risk of the project means the R value is less. Is that the see now you see what is the present value? Present value formula is cash flow divided by 1 plus R to the power of T. Now I am giving you this. Take at the rate of 10%. Okay, 10%. Cash flow, assume cash flow is how much? Assume cash flow is 100. Okay, cash flow is 100. What will happen? 100 divided by 1 plus 10 to the power of 1. 90.9. Okay, you take 12%. Is it at 100 divided by 1.12 to the power of 1? Is it at 100 divided by 1.12? How much will get? See the thing. How much the value? See 89.28. Is it right? If the value of R increases, is it right? If the value of the R value increases, present value will decrease. R value is decreasing, present value will increase. You have to keep this in mind. The lower risk of the project can be recognized by increasing which of the following. The lower risk of the project. What it says? The cost of initial investment. See, cost of initial investment is not going to recover with the risk. Is it? The estimated future cash inflows. I told you in the beginning what we are doing in the entire exercise. We are only estimating. We are making a projections. That's all. We are not doing the internal rate of return, the required. No, we are the only purpose is what we are making a estimations. Is it? That is that we will take this the rates and we'll do the estimations as such. Next, a company has a following pattern of cash flow of the project. The company discount rate is 10%. What is the discounted payback period? I told you there is one method is called as discounted payback. Okay. There is a procedure. Okay, there is a procedure at the rate of how much? At the rate of 10%. I will put like this here. I will put a cash flow. Is it a cash flow? Discount factor DF at the rate of how much? At the rate of the how much they say? At the rate of 10%. Okay, you will have the present value at the rate of 10%. You will have a cumulative. Is it cumulative present value? See, we are this is fine. Now coming back to this is point column 1, column 2, column 3, column 4. Column 4 is nothing but always 2 times 3, okay, and this is column 5. What is the rule of discounted payback? Discounted payback means the investment should be equal to the present values, okay. The moment the present cumulative present values, is it right? Cumulative present value. But the moment we'll reach this, you have to stop, okay. Now year 0, how much is there? 100,000, okay. 100. Discount factor, I told you, any discount rate, year 0, it will be 1 only, okay. How much is there? It is 100, okay. Cumulative is how much? 100. Year 1, how much is there? 40,000, okay. Discount rate, how much is the discount rate? You see the thing, 909, is it right? 10% column, year 1. It comes to column 2 times column 3, is it right? 36,360. Okay, 36,360. See, you have to put, this is minus, okay? This and this minus to plus means minus 100,000 plus 36,360, okay. Make it so minus 100,000 plus 36,360. It comes to how much? See, we have to make sure that when it will reach 100,000, okay. The moment it reach 100,000, we have to stop. Second, okay. Second, how much is there? We are talking about 20,000, okay. 20,000. What is the 0.826? Fine. How much will get? 16,520. Same rule, okay. Rule will never change, is it right? This and this is this plus this, okay. That as simple as that. This plus this equal to this much, okay. How much is there? 63 plus 16,520, okay. 47 120. Still it is in minus, okay. Still it is in minus. Year 3, okay. How much is there? 30,000. Discount factor is how much? 0.751. Is that 751? It comes to how much? 22,530. Same thing, okay. This is equal to this minus 47,120 plus 22,530. It is still 24,590. Still we have to recover 24,590. We have to reach the investment level, okay. We have to reach the investment level. How much is there? This is 5,000, okay. 0.683. This discount factors, we can do it like one divided by 1.10 to the power of 3. It will come to how much? It will come to 0.751. We can do by calculation, or we can do by, but we can see by referring the tables, okay. We can see by doing different 5,000 into 6, it comes to how much? 3,415. Same rule, okay. This is minus, this is plus. It comes to how much? It comes to 21,175, okay. 21,175. Year 5, how much is there? 40,000. 0.621. Is it right? 621. It comes to how much? 24,840. See, we need 24,840, but how much? We need 21,175, but how much we are having? We are having 24,840. How much is the same thing? Is it right? At this point, it will become less, okay. But we have to take into consideration exactly what they are asking us. The company uses a discount rate of 10% in what year? They are only asking in what year. In what year we are going to recover our payback? In the year 5. Is right? In the year. They are not asking precisely. They are asking only in what year does discount payback will occur. Is it? We have to make, otherwise we have to take the months also. Okay, we have to take the months. I will show you how it is going to be done. Okay, how much it is going to be done. Any doubts, just you post it in comments. Okay, please subscribe the channel, share the channel. Sudan company wishes to undertake a project requiring an investment of much? CF0 is 732. Okay, which will have generate an annual cash flows of perpetuity. When we say perpetuity, is it a perpetuity? Perpetuity formula is C divided by R. Okay, perpetuity is C divided by R. This is the formula. Is it? Present value of perpetuity. Is it? Present value of perpetuity is C divided by R. In the first inflow from the investment is the year after the initial investment. What is the IRR of the project? Initial investment is how much? 732. Is it? The IRR what is the concept of IRR? IRR is where the NPV will be equal to 0. Is it right? And IRR is where NPV is equal to 0. Is it? They are asking us about IRR. Is it right? The perpetuity. Is it right? IRR is nothing but the perpetuity. What is the cash inflows? Cash inflows divided by R. Okay, we don't know value of R. Is right? What is the investment? Investment is going to be 732,000. Okay, 732,000. If you want to know what the R is, right? R is nothing but IRR. Okay, R is nothing but the IRR. How much is there? Cash inflow is how much? Cash inflow is 146. Is it right? 146. 400 divided by 732, it equal to how much? 146 400 divided by 732. Is it right? It comes to 0.2 or 20%. Okay, or 20%. Fine. A simple math, as simple as that, is it? Which three of the following are advantages of IRR? See, IRR takes into consideration all cash flows. Is it right? IRR takes into IRR is first. IRR is based on discounted cash flow technique. Okay. It is based on discounted cash flow technique. It takes into consideration all the cash flows. Is it right? It takes the whole life. Is it right? It takes into consideration all cash flows. All the years. Is it right? All the years. Is it right? This is the one. Okay? Uses cash flows, not profits. Is it? It will see. Profits will be used by whom? See, profits. See, if you take the traditional methods, is it right? If you take the traditional methods in accounting rate of return, is that accounting rate of return, is that profits will be used. Okay, profits will be used. It uses what? It uses the cash flows. it is a measure of absolute. See, there is no absolute. It is only estimates. Okay, it is only estimates. We cannot say it is absolute. It is also not accurate calculations. Is it right? It is only an estimate. You cannot say we are estimating. As simple as that. Okay, we are estimating. This is also not there. This is also not there. It is useful when liquidity, there is no relation to liquidity. Okay, we are not talking about anything about working capital, all those things. It considers the time value of money. Because why it considers the money? We are using what? We are using discounted methods. Any discounted methods takes into consideration time value of money. Okay. Next. Jones Limited plans to spend 90,000 on the item of machinery, capital equipment on 2001. Expenditure is eligible to 25% tax allowable. We have done the second problem, point number 69, I think so. Okay, in the similar way, 25% tax allowable depreciation, and Jones pays corporation taxes on 30%. Tax paid is at the end of the accounting period concerned. The equipment will produce a savings of how much? 30,000 per annum. Useful life deemed to be recovery on 31st December. Again, Jones plans to spend 90,000. Is it right? 90,000. The depreciation is 25%. Tax allowable. Jones pays corporation taxes how much? 30%. How much there is a savings? The savings of 30,000. Fine. Savings of how much? Is expected useful life to be received on 31st. The equipment will be sold for 25,000 year 2005 and has a 31st December year end. What is the cost of capital? 10%. What is the present value of tax savings? The one which we have done in the previous case, it is the same thing. Okay, it is the same thing as such. Okay, now fine. We will put it as a tax period. Okay, particulars, the tax saved. Please do it. Okay, don't listen. That's take the you maintain the things. It will be very clear. Discount factor at 10%. Is it present values? Present value at 10%. Okay. Now this is column 1. Fine. We don't need all. We'll put the things. Okay. This is 2. This is 3. This is 4, and this is 5. Fine. Now year ended. Is it right? Year. How much is the cash? What is the cost? Cost is how much? Cost is how much? Cost is 90,000. Okay. Cost is how much? Cost is 90,000. 90,000. What is the depreciation they are saying? 90,000. 25%. Is it right? 90,000, 25%. Tax allowable depreciation. Tax allowable depreciation. 90,000 times 25%. Is it a 9? How much it came? It comes to 22,500. 22,500 at the rate of how much? At the rate of 30%. Okay, 22,500 at the rate of 30%. How much will get? 6,750. What is the discount rate? Discount rate is 0.909. Column 5 is nothing but column 5 is 3 times 4. Okay, column 5 is 3 times 4. It comes to how much? 6136. Yeah, year ended. This is the first year, is right? This is the first year. Year ended, is it? Now it is second year, 31/12/2003. Okay, 31. How much you will get here? What is the balance? 67,500. Okay, 67,500. Tax allowable depreciation is how much? Tax allowable depreciation is 67,500 times 25%. Is it 67,500 times 25%? It comes to how much? It comes to 16,875 at the rate of 30%. Okay, at the rate of 30%. 5062.5. Okay, 5062.5. 5063. 0 point. What is the discount factor at the rate of 0.826? Is it 0.826? It comes. So you can do it in online on computer based examination. You can use the Excel sheet formula. Okay, it is very easy and it will be done very quickly also. That 4182. 4182. This is, see, this is year 1. Is it? This is year 1. This is year 2. Okay, this is year 2. Is it? And this is 3. Okay, this is 3. How much is there if you take this into consideration? 67,500 minus 16,875. It comes to 50,625. Okay. Again, same thing, tax allowable depreciation. The tax allowable depreciation, how much? 5625 times 25%. Okay, times 25%. It comes to 12656. Is it right? How much? 12656. At the rate of 30%. Okay, at the rate of 30%. It comes to 3797. Okay, 37797. 0.751. Okay, 0.751. It comes to 2852. 2852. Is that year 4? Is it right? How much? What they are saying? See that thing. See, when they have purchased, they purchased in 2002, 2003, 2004, 2005. Okay, means how many years? 4 years. Is that how many years? 4 years. Year 4. Is it right? How much will get here? How much will get here? It comes to 37,969. Okay, 37. Year 4. What happened? There is a disposal. They have sold it. Is it right? There is a disposal. First, you have to deduct the disposal. Okay, disposal is how much? 25,000. Okay, disposal is how much? 25. What is the balance is there? Is it? What is the balance is there? 37,969 minus 25,000. 12,969. 12,969. Is it? Again, same process. Tax allowable depreciation at the rate of 30%. Okay, at the rate of 30%. It comes to 3890.7. Okay, you can put it as 3891. Okay, 0.683. Okay, 0. How much you will get? 4,658. This is from Kaplan. Okay, this is, I am following Kaplan throughout the things. Okay, please subscribe to this channel and share this channel. Okay, it has to reach as much as possible, and students should get the benefit. 6136 4182 10 12 18. Okay, 10 12 18 2851. Okay, 15828. What is the answer? 15828. Right? 4 projects. How many questions are there total? You have, okay, fine. 4 project PQRS are available to the company which is facing shortages of capital over the next year, but expect capital to be freely available thereafter. Total capital required the project is how much? They say total required over the life is 20,000, 30,000, okay, 20,000, 30, 40, 50. Capital required in next year 20, 10, 10, 30, 40. NPV is how much? 64. NPV of project at company's cost of capital 60, 40, 80, 80. In what sequence the project should be if selected if the company wishes to maximize the present values? Yeah, when it is going to be maximize the present values. See, when you want to maximize the present values, is it right? Free 4 projects which is having a shortage of, means what they are doing, they are talking in terms of capital rationing, profitability index. Immediately we have to think about profitability index. Okay, next, what is the NPV? NPV divided by the NPV divided by the capital required. Okay, NPV divided by initial investment. NPV divided by initial investment. P, how much is the NPV? NPV, see, PQRS. Fine. 60 divided by 20. Okay, 60 divided by 20. It comes to how much? This is the index. Okay, this is the index. 40 divided by 10, it comes to how much? It comes to 4. Okay, 80 divided by 30, it comes to how much? 2.67. And 80 divided by 40, it comes to 2. Rank it. Okay, rank it. Which one should be first? Which one should be second? The first one is which is highest one. Okay, you rank it the things. This is the first one, this is the second one, this is the third one, and this is the fourth. Based on, see, when you are talking, see, profitability index, is right? When you are talking in terms of profitable index, based on profitability index, rank the projects. It will first welcome Q, is it right? Q, P, is it? Q, P, R and S. Q, P, R and S. Okay? Fine. I will stop here. Okay? In the next session, I will start from 81. Okay? Okay, a small short sessions will be there. Based on that we will do. Fine. Are you clear about this, how we have done the things as such? Fine. Just first, before we go further, make it sure that you understand the initial 5-10 minutes are important. Subsequently it will be easy for us. Okay? What this is in the 5th series. Okay, next time when we are doing, I will do the in terms of 6th one. Okay, I will do in terms of 6th one. Are you clear about this? Fine. Thank you so much. Again, I will say subscribe to this channel, share this channel. If it is really made difference in understanding, please like the channel and post your comments. What in either way. Okay. Thank you so much.